Okay, so I'm the last presentation of the series, and I'm going to cover some of the most basic fundamental stuff. But if you haven't been paying attention to it, you should, because these things will greatly increase your chances of success. So I am the author of Day Trading for Dummies. We just came out with the 5th edition this past winter. And my background is in finance, especially financial journalism. So I really approached this more as, I was a reporter talking to traders. I talked to close to 100 traders over the course of 5 editions of this book, and just trying to find out what works and what doesn't. And what I have discovered from talking to people is that money management and risk management are the keys to trading success. That we often, traders are always looking for great setups and great strategies, and those are really important, but those often aren't repeatable. And that to a certain extent, if you look at the odds of day trading, it's pretty close to break even. So if you can manage your money and your risk, you are in a much better chance because you will protect your losses, and then you can let your winners run more. And so even if only half of your trades work out, if the half of the trades that work out make more profit than the half of the trades that don't work out, you are money ahead, right? So the math is fairly simple at this point. I know we can get into a lot of complicated math, and if you're excited about this, you can, but let's just get started with some very simple stuff. So what we're going to cover today are the basics of trading plans, and we're going to talk about choosing a money management system. I'm also going to give you a brief reminder about the importance of stops, okay? And again, if you've been trading for a while, you may know these things, but you might have also gotten, we all get like a little lazy sometimes. So, thinking about getting back to the basics can really help you. And if you're new to trading, starting with these core principles is going to make a huge difference in how long you can stay in. I read so often these sad stories on message boards of people who they're doing well, they're doing well, they're doing well, they can't believe it, and then they bust out and lose everything, sometimes on one trade. So you're going to start with the trading plan. Doesn't have to be difficult. There are traders who keep their trading plans in old notebooks. There are also computer apps and some brokerage firms that'll even pull in all your data and help you get this set up. But before you start to trade, you want to sit down and think about how much you're going to trade, why you're trading, where you're going to place your stop, and where you're going to close out your trade. How much you're going to trade gets into the money management that we're going to talk about in a few minutes. Why you're trading can help you start to think about the psychology. And I know there have been a lot of people today talking about trading psychology. One of my friends, who's a longtime trader, says trading is nothing more than video games and psychology, right? But it's, why are you trading? Are you placing this trade because you've been watching the setup and you have seen how the moving averages are going up? You're seeing some momentum in the price. You're expecting some news flow that's going to create a lot of volume. Or are you trading because you just know it's got to work out today, and there's everything in between. But being able to identify why you're placing that trade is really important. And as you get into more and more automated trading, your ability to specify every step of the way what you're looking for will make it much easier for you to build a program to automate your trading. So that's key. And then where you're going to place your stop and what your target is, where you're going to close it out. The stop will close your trade automatically if it goes against you. On the upside, you're hoping to let it maximize. How long are you going to let it run? What's your target? And what's the point where you say, okay, either this isn't working out or it's time for me to just take my cash and go, right? So you got to think about that. When you keep a trading plan, then you can write down how your trades worked. And if you do it as you place your trades, and again, this can be automated at a lot of brokerage firms, or just keep it in your old notebook or whatever, but then you can start to evaluate your performance. And this will help you learn. It will also help you as you calculate more sophisticated kinds of money management and more sophisticated types of stops. But you can't know what your risk is, and you can't know what your advantage is if you don't collect the data. And there are people who don't do this. So if you do this, you're ahead. You'll start to understand where you have an advantage in the market. And it can be related to your ability to spot things. It might be your ability to do clean execution. It might be your ability to cut your losses and stay in the game longer than a lot of other people. And remember, you're not competing against other traders. You're competing against the market, right? All these traders that you heard from today, all of the other people on this call, they're not your competition, right? So, again, that's a key part of the psychology. Okay, but now getting into what I think is the most important thing that new traders need to do, and the biggest way that many experienced traders can improve their performance if they haven't been paying attention. And that's basic money management. Namely, how much money you put on each particular trade and what your logic is for doing that. Now, I know a lot of people sit there and they think, well, it's a hot idea. I should just put everything in it because there's no way it can go wrong, right? Well, even if the idea is perfect, you could enter the trade incorrectly. You could accidentally buy puts when you mean to buy calls, or place an order to go short when you want to go long, or you could enter the wrong ticker symbol. And these things happen all the time. They happen to professional traders. We've seen occasionally the weird blips in the market that they blame on fat fingers, where somebody just makes a mistake. So if you have a perfect winning trade with a 100% chance of success and you enter the wrong ticker symbol, it blows up. So that's one reason you want to limit how much of your capital you place on each trade. If you have the information on your risk and reward, you can really start to think about how to scale trade. So when you're doing your trading journal, your trading plan, you want to keep track of how many of your trades lose, what percentage lose, what is the typical loss on a losing trade. And again, it might be close to 50%, but if you can keep that loss smaller, you're in good shape. What percentage of your trades win, and what is the typical gain on a winning trade? And this will give you your expected return per trade, and it may be fairly small, but again, you're compounding this over a large number of trades per year. So a small daily percentage expected return is going to add up, again, if you can keep your discipline on this. So then we get to this fun number called the probability of ruin. And that number is R. And that is, so you find A, which is the percentage of winning trades versus the percentage of losing trades. And C is the total number of trades that you make in your account. If you, say, have enough capital to place 10 trades at once, and your probability is the pure 50-50, right? So then you have, A becomes 50 minus 50 is 0. R is 1 minus 1, your probability of ruin is going to be 100%, right? So you are looking at having even a small advantage in the number of winning and losing trades to reduce the probability of your account wiping out. So that's one number to keep in mind as you start collecting data. If you have your probability of ruin, like I said, it's 100% if you have no trading advantage. If you have even a small advantage, a 1% chance, a 1% advantage, you've reduced your probability of ruin down to 81%, which is still very high. Okay, day trading is something that a lot of people lose money at. And I'm going to be really upfront with you about that. And one of the criticisms of my book is that I discourage a lot of people from day trading. And I mean that sincerely. If you're not cut out for day trading, you shouldn't do it. Some people are cut out for it. They have the discipline. They're able to approach the market. They're able to find patterns and setups and work from them. But if you're not one of them, you shouldn't lose money, right? You should there are other ways to spend your time. There are other ways to make money. If you have an advantage, though, you can start to hone that advantage to make it work for you. Okay, so here we have like a big spreadsheet about your trader's advantage and the number of trades that you place and how your probability of ruin changes, okay? So again, small advantages, if your advantage goes from 1% to 2%, and you have 10 trades, you can see your advantage starts to get smaller. And as your advantage grows to say 20%, your probability of ruin gets even smaller. But one thing you'll notice is that this number goes down the more trades you're able to place out of your capital, okay? And so that you want to keep in mind as we get to the next concept, how many trades you place. And there are a lot of different position sizing systems. GAN is simple. As you get into more math, as you have more data, you might want to go with fixed fractional or Kelly criterion. Martingale is an old gambler's technique that works for a lot of people. Your broker may allow you to do a Monte Carlo simulation, which will give you something that will reduce your risk of ruin further. So GAN is the easiest, easy peasy. It was developed by William Gann, who is an experienced commodity trader, and he developed some fairly complicated systems for placing trades, but his money management system was super easy. Just says divide your money into 10 equal parts. Never place more or less than 10% of your trade or 10% of your money on any one trade. There are a lot of professional traders who stick to Gann. They never have more than 10 outstanding trades at a time. This allows them to pay attention to what they're doing, or more attention, and they just look at 10%. If you have a relatively small trading account, this might be relatively small amounts of money, but again, your goal is to compound this, to take small successes and build them over time so that you get greater return. And a small percentage trade can compound a lot over time. Goldman Sachs has made a fortune on an edge of less than 1% because they're using leverage, because they have so much capital that they can put into the money that they can do it consistently. So huge amounts of money can be made on small trades. GAN, super easy. If you're starting out, I think I'd stop at GAN, at least until you have enough data to look at another system. So the more complicated systems, there's the fixed fractional system, was developed by Ralph Vince, who is another old name in the trading game, but you may see his stuff. And he says that you should look for the number of shares or contracts that you're trading. Again, he was looking primarily at the option market. You start with the number called F, which is the fraction you wish to trade. So let's say 10%. Equity is the value of your account. And the trade risk, and that's an absolute value, so you want it to be a positive number, that's the amount you can lose. And that is 100% if you don't have any stops in your account, okay? But if you have stops, you can lose less money, obviously. And so you use that to figure out what fraction you want to trade of your account. So that's an approach to use. The Kelly criterion, some of you may have heard there's a legend that's somewhat true about a group of physicists and statisticians from MIT and Bell Labs who went to Las Vegas in the 1960s and made so much money that, first of all, they changed the way roulette wheels work. They added the green so that the odds are now worse. And secondly, the legend is that if you're a graduate of MIT, you can't trade in any casino. I don't know if that's true, but there is that legend. But part of what they were doing, this group of scientists, was they had developed a money management system that they called the Kelly criterion. And that is the percentage of the account you want to trade, the Kelly percent, is based on the percentage of your trades that win. And then you find this number called R, which is your average gain divided by your average loss as a percentage. So if your average gain is 10%, your average loss is 2%, your R becomes 8. No, 10 divided by 2, your R is 5. I shouldn't do math in my head. Your R is 5, right? And you find the percentage of trades that win, and then you find the percentage that you can use. So they had an edge. It was a very small edge in roulette at that time, but it was enough of an edge that they could use that to stay in the game for a long time and change the rules. So you can't use it in Vegas anymore, but you can use it day trading. Martingale is a very old casino system, very widely used still. And it will work if you have an infinite amount of money to trade. Now, that's a major restriction, but, maybe you have infinity, or maybe you just have a lot of money to trade. So you start with what your set dollar amount is for your first trade. So maybe you say $2,000. If that trade wins, you place the same amount on the next trade. So you have a $2,000 trade, you make a few percent, then you place another trade for $2,000. And you keep placing these $2,000 trades until you have a losing trade. If you have a losing trade, you double the amount. So if you lose 2,000, your next trade you place 4,000. And if that loses, you place 8,000 on the next trade. When you hear about gamblers talk about doubling down, this is what they are doing. It works, but there is that hurdle of infinity that makes it really, really hard. And economist John Maynard Keynes said, 100 years ago or whatever, that the market can remain irrational longer than you can remain solvent. So doesn't work perfectly, but if you have a larger account such that $2,000 or whatever your initial trade amount is much less than 10% of your initial trade, you could give it a try, and see. Again, some of this is what works for you and your personality. If you're more quantitative, you might want to try something else. If you just want to keep your life simple, you might want to go for GAN. Monte Carlo simulation is another system that works well mathematically. Up until fairly recently, it's been almost impossible for a day trader to do because it's required so much computing power, but computer power has increased dramatically from even 10 years ago. And so many brokers include this in their list of tools. And it is a simulation that runs a range of basically runs the test a large number of times and then spits out the optimal trade size. So you would go in and you would enter your risk and return parameters into the model. You would enter in your account value, and the system will then run and spit out your optimal trade size. And it will vary with each trade. It's because your account value will vary, the risk and return parameters will vary, and also the type of trade will vary. But it might be one to experiment with. If you experiment, again, keep notes in your trade journal, how these things are working so that you can go and evaluate. And you might want to say that, you're just going to go back to the GAN system because it's so easy and you didn't see a significant advantage. Or maybe this does work for you, but what you want to do is be consistent. Like if you experiment, and experimenting is good, but you need to take notes on your experiment. You don't want to be the person who does one thing one day and something else the next day and something else the next day based on your mood, right? You want to start with the system. You want to see how it works. You may want to experiment with a certain number of trades using another system to see if you get a better return. But you want to keep notes so that you can go back and evaluate it. An experiment that isn't recorded is just a guess, right? Because you can't learn from it. With all of this, I want to reiterate the sheer importance of using stops. Again, this is basic trading, but if you've gotten a little sloppy about it, this is a good time to go back and be like, okay, I'm going to commit to the stops because they make a huge difference. Brokers offer different kinds of stops. Some people try to avoid them because brokers charge commissions on stop orders, but not on regular orders. But they charge commissions because they're valuable. And a lot of brokers don't charge commissions because here's one of the dirty secrets about the brokerage business. Brokers would like to keep their customers in the game because that's how they make money. If you get in and you bust out, they've lost a customer and then they have to go find another one. They would rather help you be successful. So you take advantage of the stops that you have. If your broker charges an extra fee for it, pay it. If they don't, better. Again, assuming you're getting good execution. A stop loss is simply placed at a certain level based at an amount. You purchase a stock at 100, the stop goes to 95, bam. As soon as it goes to 95, your position's sold. A lot of fear of missing out goes into this because people are like, well, what if it goes to 95, but then it immediately hits up, there's an announcement, it goes to 110, and I've just lost all this money. You don't care. Once it's sold, it's sold. Just move on to the next trade. In the long run, having a stop will help because wishing and hope, you hear this over and over, wishing and hoping is not a strategy. More often than not, if the stock goes to 95, it's going down for a while, right? Trading is about momentum, and you lose that momentum and then you're hoping for the miracle. And, miracles may happen to poor children on Christmas Eve, as Bart Simpson said in the very first episode of The Simpsons, but they don't happen that often to real people. And quite frankly, if miracles do happen, I'm sure you're a lovely person, but I think there are a lot more important things than the stock that went to 95 immediately zooms up to 110. So, just keep that in mind. Okay. Trailing stops are going to follow based on a percentage change in the stock. And especially if you're dealing with something volatile, or if you're planning to hold if you're swing trading instead of day trading. This can help protect you on the downside while giving you some upside, okay? I would start with fixed stops and then experiment more with trailing stops or volatility stops, which are based on average true range. That might give you some flexibility if you're dealing with something that is unusually volatile. But again, if you're experimenting, keep notes so that you know what's going to work relative to your trading style. If you're paying commissions for stops relative to the cost of the stock, and relative to the actual volatility you're seeing in the market. So, again, if you're going to be simple, go with Gann, keep your trading record in an old notebook, go with fixed stops. If you're going to be complicated and you have records, you can keep your trading system online and you can calculate your winning percentages and your risks so that you can operate the Kelly criterion and you can experiment with trailing stops. But again, if you're going, doesn't mean you're going to get better performance. And you'll know if you get better performance in part because you have good records, okay? Doing fancy strategies doesn't make you a better trader. Having good discipline will make you a better trader. All right. So do not trade without a stop in place. I like that little symbol. And I think that's really important to keep in mind. Just don't. So here's your summary. Nice and simple. Money management's your key. That's what's going to keep you in the game longer. Because again, this is a game of small percentages, making small gains over a long period of time. Small gains of daily trading over a long period of time that compound. You want to track your trades so that you know what's happening. Track your trades. Okay. Goldman Sachs, all the big brokerage firms invest a ton of money into trade performance systems so that they can understand the risks, so that they can give bonuses, so that they can calculate their profits and refine their strategies. And given that you can do it in an old notebook, Goldman Sachs doesn't, but you can. There's no reason not to. You can get more sophisticated if you want to. And if it helps make it easier, you can, but you don't have to. Any trade can go to zero if you don't use stops. Some trades can go past zero if you don't use stops, right? Like if you're doing naked put strategies, oh, yay. But given that things can go to zero, you want to have a stop in there. It's going to protect you against losses far more often than it's going to keep you from making a profit, right? You're going to remember that one case where you had the stop at 95 and the stock immediately went to 110. But if you actually go through your records, you're going to find that that really didn't happen as often as you think it did. Any sure thing disappears if you enter the trade incorrectly. If you're new to trading, I would suggest that you use your broker's paper trading function, their trade simulation function, to practice making good error-free orders. One trader I've talked to says that you should make at least 20 practice orders entered correctly before you start trading with real money. And if you screw up one of those 20 trades, you go back to the beginning until you can enter 20 correctly in a row. Again, it doesn't take a lot to enter something wrong. And that is one of the advantages of automated trading, especially as you get more data about the success of your strategy. And if you don't know where to go with Gann, limit each trade to 10%, tack on a nice fixed stop, and you're clean. So with that, I would love to hear if you have any questions or anything that you want to discuss. And I will check in the chat. And if not, I will simply wish you a fine Thursday evening, but I am here for your questions. Yeah. And, do I mean with Gann, 10% risk or 10% capital? That is 10% of your capital. So if your trading account is $20,000, each trade should be no more than $2,000. If your trading account is $2,000, each trade should be no more than 200. So it is 10% of your capital, so that you have no more than 10 trades going at a time. And we know that in investing, diversification is a key to risk-adjusted return, and that actually goes with trading. You know, having 10 trades in place or having 90% of your money not trading so that it's there if the trade doesn't work out, that's going to help you reduce your risk and increase your risk-adjusted return. And kind of curious is about this, like how many people knew all this already and you're just sitting there like, yeah, whatever, lady. And how many of you found this new or thought it was a good reminder? And you won't offend me if you tell me you know this already. So, yeah. Some new. Okay, that's good. That's good. The dynamic stop loss. Yeah, it's not all brokers have it, and it requires a little bit of extra. Again, you need to have more data to do it. Yes, you ordered the book. It is available at all major booksellers. It's also available at your public library if you don't want to spend the money. And public libraries are big buyers of books. And many libraries, if you don't have a library card, you really should get one, because libraries have books, they have eBooks, they have magazine subscriptions. You know, if you're doing more investing rather than trading, a lot of libraries have access to Morningstar. So, you know, you can get all that information right there. And I'm based in Chicago. In Chicago, the library has museum passes. So if you can go to the Art Institute of Chicago for free once a year with your Chicago Public Library card. And that's normally a $30 museum. So that's pretty cool. Listen to once a week for a year. That might be a lot. You might get real tired of my voice after that, but but yeah, it is a good reminder, because a lot of people know this stuff. You know, it's like we all know we should eat more fruits and vegetables, right? We all know we should floss our teeth, but we don't as much as we should. So, yeah. All right. Well, I think that's it. So I will let you go. And you can get on and enjoy this beautiful Thursday evening. And I don't know if our host has any closing remarks or not.